I am told we are live, so welcome to this first panel of this conference, a conference on universal basic income, but a panel that doesn't have universal basic income in the title, which is because we're going to talk about the macroeconomic context in which universal basic income may or may not be the right way forward. My name is Martin Sandbu. I'm the European economics commentator at the Financial Times, and I'll be sharing this session, which has four fantastic panel participants, and I will just very quickly introduce them to you all in the order that they will speak. James Smith is a research director at the Resolution Foundation, where he leads the foundation's work on macro policy. Geoff Crocker is editor of the Basic Income Forum and the author of Basic Income and Sovereign Money. Francis Coppola is a prolific blogger, the author of the Coppola Comment Finance and Economics blog, and writes for many other publications. And Joe Michell is associate professor of economics at University of West England at Bristol. I'd like to say here at Bristol, but we're all in cyberspace these days. In any case, wherever you are, welcome to the panelists, welcome to the audience. We have this panel on macroeconomics because we're in a time of great change in macroeconomic thinking and macroeconomic policy making. On the monetary side, we see things that not long ago very few people would have foreseen: negative interest rates, real long-term interest rates set to be low for a very long time. It looks like huge asset purchases and other innovative policies by central banks. So we'll think about what that means. On the fiscal side, we've had a decade of austerity behind us, and that has affected both the economy and how we think about the economy. So one thing we want to ask is, what is the right way to think about fiscal policy going forward? And in particular, should we worry or stop worrying about taxing and spending? Many of you will have watched Stephanie Kelton's keynote, I think last night. And of course, where does UBI fit into all this? Is it a policy whose time has come? And what does the new macro landscape tell us about that? We really want to get to your questions. We have four excellent panelists who will get 10 minutes, but no more. So I have warned them that I will be very rude when they get to 10 minutes, and we'll give them an advance warning. And then I really want the audience to bring their questions to bear. So use the ask a question function if you have a specific question. Feel free to use the chat for any kind of comment apart from direct questions. And if you write a question in the chat field, that's fine too. The amazing festival staff will bring it to my attention. So without further ado, I'm just going to hand it over to the panelists and let James set us off. James, the floor is yours. 10 minutes, please.
Thank you, Martin, and thank you to the organisers for inviting me to this great event. I'm really looking forward to a really interesting debate here, and some really great panelists here. So, as Martin says, I focus on macro policy at the Resolution Foundation. That might sound slightly like an oxymoron, so I'm going to explain why all that's really important. So we're focusing on macro policy today. So this is mainly decisions by the Bank of England and the Chancellor that affect the whole economy. Now, macroeconomics has a, I think, pretty deserved reputation as the nerdiest and most jargon-shrouded areas of economics, which is itself a nerdy and jargon-shrouded subject in general. So you might ask yourself, well, what has macro policy got to do with UBI, got to do with inequality, all the things that this conference is really focusing on? Now, at the Resolution Foundation, last year we wrote a nearly 120 pages on that very question. So, you should be worried that I'm about to give you the full version. I'm not. I'm going to give you a very short version of all that, a potted down sense of what we were thinking about, but this is an incredibly important set of issues, as I'll come on to talk about. What I'm going to do is talk a bit about the past, how we got to where we are today, a little bit about the present and the current crisis, and then think a bit about the future for macroeconomic policy and what it all means for living standards and inequality and that kind of thing. So let me start with the past here, and what I'm talking about is really the deep, dark, ancient past here. So before two once in a century crises, basically a time that none of us can really remember. So I'm talking about 12 years ago, when the world was completely different. And at that time, we were used to a world of low and stable inflation. The economy grew consistently at something like 3%. And most importantly, we were seeing consistent year-on-year improvements in median income, living standards, measures that were telling us people were generally better off. And in short, I think macro policymakers basically thought they had it sussed. So the combination of a central bank trying to hit a numerical inflation target with rules-based fiscal policy that focused on sustainability was generally thought to be the state of the art and exactly the right way for us to think about policy. But once the financial crisis hit, all of that really ended very abruptly. So inflation was very volatile, GDP growth fell and has been incredibly weak since then. And most importantly, living standards have barely improved in the 12 years or so since the crisis. So there's tons of ways to look at this, but having grown pretty consistently in the run-up to the crisis, real pay growth has averaged something like 0% in the decade or so since the financial crisis. So, and the key thing, and the key reason why this is a macroeconomic issue, is that this didn't just affect the poorest in society, it affected people right across the board. So if you look at people in the 10th, 25th, 50th percentile of the income distribution, there's really similar things going on. So, it was hardest for those at the bottom of the distribution because cuts in government services were making it feel worse, but it was a broad phenomenon, this. And it was basically the job of macro policy to deliver year-on-year improvements in living standards across the board, and we just stopped seeing that. So it was a huge failure of macro policy that we've seen since the financial crisis. And if I fast forward to the present crisis, all this has major implications. So for starters, the legacy of the crisis has meant that people on lower incomes have come into this crisis with incredibly weak balance sheets, with many having little or no savings. I guess the second big implication is that the really low growth, low inflation environment that is the legacy of the financial crisis basically means the Bank of England can't set policy in the way that it would hope to. So during the financial crisis, the Bank of England cut rates by over 5 percentage points. Started QE, we think that boosted the economy by about 8%. So a huge stimulus from the Bank of England. They can't do that in future. Clearly that's not going to be part of this crisis. So what about the future for macro policy? Well, I think all of this has really big implications. And most immediately for this crisis, it means that because the Bank of England is not supporting the economy, fiscal policy has to do that job. And you can't think about fiscal policy in the way that you have thought about it in past recessions. So the size of the debts that are going to be built up, the size of the fiscal spending is going to be larger because it's trying to fill in for the other parts of the macro policy framework that aren't actually able to work at the moment, namely monetary policy. So we think the deficit is going to be something like 400 billion this year, it's the largest peacetime deficit, and that's really telling us that fiscal policy has to do something completely different in this crisis. So if there's one thing people should have in mind about the coronavirus crisis, that is it for me. It's a different crisis in terms of macro policy terms. And the key thing here is nothing. The Bank of England can't provide the stimulus to generate that rapid recovery. So that will be the job of fiscal policy. So we can't think about fiscal policy in terms of how we set it in the way that we did in the past, and it really needs to focus on delivering that rapid recovery and being more aggressive. And if we don't do that, then the risk is that we fall deeper into that low interest rate, low growth malaise, and all the implications that may have for society, for politics, all the rest of it that I think many people are worried about, not least at this conference. So that's the kind of immediate implication. What about how we do macro policy going forward? Well, for me, and I won't say much about this, but for me, the big implication is we just need to rethink how we set macro policy. So we need to rethink how we do monetary policy. We, for example, have called for a higher inflation target. But the biggest thing, I think, is how we coordinate the overall tools of macro policy, so monetary policy and fiscal policy, in order to generate that rapid recovery and are able to bring about an improvement in the macroeconomic performance for the UK that has been absolutely dismal. So I'm going to finish there. I think the big challenge is making monetary and fiscal policy work together, and I think some of the other panelists will have some really interesting ideas on how to do that.
James, thank you very much. That's it's kind of a depressing introduction, really, because what I took from that was huge failure of macro policy in the past crisis, and since the past crisis, we're left with a legacy from that makes things harder now. Monetary policy pretty much impotent. You need to spend like crazy on the fiscal side, but of course, some people will then worry about the debt. I'd love to come back to you later about what you make of possible unconventional monetary policy, negative interest rates, and so on. But let's get back to that at the end. Maybe some of the others will pick up on the potential for that. But for now, I hand over to Geoff. Geoff, your 10 minutes.
There's too many video sources.
You and see you. Just go ahead.
I'm wanting to share my screen. One moment. Okay, can you see the slides? I can't hear you at the moment, but hoping you can hear me. So I'll jump straight into talking about funding a basic income via sovereign money. Is it the time for a universal basic income from this conference? I'm assuming for this presentation that the case for basic income has been proved on other grounds. Grounds of social justice, i.e. addressing inequality and precarity, points made well by Guy Standing in his various books, and in sharing an inherited infrastructure and technology, rather than that just being owned by a privileged class. Everybody's born with an inheritance to that, and that's reflected in a philosophy for a call for a basic income. Secondly, a best welfare system, that whatever welfare benefit system we have, basic income is the best because it's less intrusive. It gets rid of the humiliation and demeaning nature of an intrusive regime. It's therefore lower cost administratively. It has higher take-up than means-tested benefits. And very importantly, it avoids unemployment and poverty traps, because unlike current welfare benefits, if someone moves from being on welfare to taking a job, they currently lose virtually pound for pound, therefore facing a huge disincentive, and basic income overcomes that disincentive. Thirdly, macroeconomic demand. If the crisis in 2007 was about anything, it was about a consumption and demand crisis. It was a Keynesian crisis, where aggregate demand was suppressed, and because of income suppression reducing as output increases, leading to debt, which basic income proposes to overcome. It also has benefits ecologically because it ultimately breaks the link between income and yet more output, yet more resource depletion, and yet more pollution. And finally, it enables human flourishing because it allows us to have the choice of lifestyle which the technology is making available to us. So there's more for anybody who wants to look at that on a case for basic income at the website ubi.org. We assume also, that we understand that the present system is in a mess, which Martin has already referred to. We've got economic crisis, actual and repetitive. We've got pervasive debt throughout the system. We've got continuous austerity policy, extensive poverty, including in-work poverty, demonstrating that work is not the solution to income that it used to be. We have low-paid jobs, increasing inequality, ecological damage. So as Martin just said, we drastically need, as James just said, a radical rethink of our economy and a re-engineering of the system. Now, the explanation that most people favor of the crisis is the bad guy theory, i.e. bad banks behaved badly and created excess debt, and bad governments failed to regulate, and that the correction proposed was to have tighter bank regulation, quantitative easing, and austerity. The challenge to that is that it hasn't worked, and it's not actually a very credible thesis that everybody in all places at the same time behaved badly. I'm advancing a theory that the crisis was actually structural rather than behavioral. And to get there, I propose a hypothesis on basic income and sovereign money through a thought experiment. In the thought experiment, a machine is plugged into the earth, a totally automated economy, and there are no wages. In this situation, clearly, the output would have to be distributed via something like an annual voucher. And my suggestion is that in total automation, we see an economy with 100% basic income and 100% sovereign money, which is the equivalent of the vouchers. Now, of course, we're not there, so we face a nuanced argument. The nuanced argument being that in high-tech economies, some element of unearned or basic income is an essential component of demand, and some element of sovereign money is essential to fund both that basic income and government expenditure. And these are therefore consistent proposals because they derive from the same thought experiment. The empirical evidence, as I'll go on to show, is that earned income has declined against consumer expenditure from 1948 to 2016.
Let's look at this graph because it's pretty illustrative.
I'm sorry, I've got a voiceover
shift
operating there.
In the structure of the economy. So it shows consumer expenditure in the lower line to begin with, and labour income, i.e. what people earned, in the bolder line. I'm afraid I'm colourblind, so I can't.
So in that last slide, we saw that from 1948 to 2016, earned income has become increasingly inadequate for the purchase of consumer expenditure. We're all equally aware on this slide that the empirical evidence is that debt is everywhere. We have huge household debt of 1.2 trillion in 2018 in the UK, which is 61% of GDP. And although 1.16 trillion of that is property debt, much of that is actually borrowed for consumption. And there is the ONS data below, 7 billion in student debt. The empirical evidence at macro level is also that there's debt everywhere. 85% of UK GDP, 234% of Japanese GDP, and of course COVID is pushing that up. The problem emerging from that is that debt constrains expenditure. It constrains household expenditure because people on lower incomes are already in excessive debt from high rates from payday lenders, and it reduces government expenditure through austerity programs because governments think they face a deficit constraint, which Stephanie Kelton helpfully exploded that myth in her book and in her presentation yesterday. So conceptually, I want to propose replacing household debt with basic income, which is funded by sovereign money, and replacing government debt with sovereign money to restore austerity cuts. That does require rethinking the definition of money from financial orthodoxy, where money gets its value from gold reserves or the sale of government bonds, where money is real and cannot be destroyed, where government budgets must balance, and where affordability is defined by government financial reserves, to a more heterodox theory where money has no inherent value but derives its value from output GDP. Looking at how to fund UBI, the usual challenge is that UBI is either too small to be meaningful or too large to be affordable. And in these funding options here, revenue neutrality from several UBI proposals, wealth tax, land tax, and eco tax, each of which I think have their detractions. Wealth tax difficult to manage, land tax doesn't capture the profits from FANG companies, eco tax should be self-cancelling. We look to sovereign money. So defining sovereign money, we have the definition of Stephanie Kelton and the MMT school that sovereign money funds a job guarantee, must be matched by debt creation and balanced out by the so-called godly identity. We have the definition by Joseph Huber that sovereign money should replace commercial bank lending because they were the cause of the crisis, and my own proposal that sovereign money should fund UBI and be free of debt and avoid excessive consumer and government debt. And there's a summary in the table. Here's an attempt just to capture the money flow in the economy. Simply from the bottom, we'll be familiar with consumers and firms purchasing goods and services, paying wages and taxes to government. But up at the top,
2 more minutes, Geoff.
Government currently buying bonds from the pension and insurance companies to feed money into the economy. The sovereign money proposal, of course, would be that government, perhaps via its central bank, issues money directly into the economy. The lessons from the crisis are that the Bank of England now holds 745 billion in government bonds, which it's bought in the secondary market. I'd claim that's somewhere equivalent to sovereign money, and it works. And secondly, the furlough scheme, which has also shown that a sort of variant of UBI works. Here's the ultimate of an economy where output is enabling debt-free sovereign money, funding government expenditure and basic income, tackling austerity, tackling poverty and equality, ecology and no crisis. And there's the website to look at. And finally, a brief reference to my book, which I can do without any conflict of interest, because I get zero royalties from it. And nicely endorsed for me. Thank you very much by Nick, who's chairing our conference. Thanks very much.
Thank you so much. Truly radical. It strikes me that people call it sovereign money when they like it, and they call it helicopter money when they don't like it. Although maybe there's a difference there that we can tease out. It's quite interesting that we've had from the two first presentations quite, similar, or at least aligning diagnosis that we're in a mess. But it seems to me James staying somewhat within the
I feel like Martin was in full flow there. We've missed him. Should we just go to the next person? I can't remember which order we were going in.
It's me, I think. Okay, are we live? Are we still live? Because if so, since Martin has died, I shall just carry on. Been very interesting comments from James and from Geoff so far, and I don't think I'm going to deviate very far from them, really. So what I was going to do, also sort of starting with slightly historical perspective, was just to look at the relationship between fiscal authorities and central banks, because I think that is the heart of what's been going on in the last 10 years and what we really need to rethink now. We had a kind of orthodoxy that kind of said, I've actually seen this said, the central bank is responsible for the economy and that for managing the economy. And the job of the fiscal authority is to keep debt and deficit, government spending under control, and debt and deficits, keep debt and deficits down, and to set up automatic stabilizers to keep the economy on an even keel. It doesn't work. We know it doesn't work, because that's kind of what we've been doing over the last 10 years. And what's happened is that central banks ended up trying to do far too much, and fiscal authorities spent all their time trying to keep debt and deficits under control. And to do that, actually shredded their automatic stabilizers. So we have a less effective safety net than we had 10 years ago. And the price we're paying for that in the current crisis is that we have public services that are inadequate to support the needs of a pandemic economy. to support the needs of people in that economy. We have no means of getting money to people, no reliable means. We come up with schemes like the CARES Act in the United States, with its distribution of $1,200 checks to everybody. Checks in the 21st century, yeah. And they can't get them to everybody. We're still trying to work out how to get money to people. So ideas like helicopter money, of which I am a supporter, indeed I wrote a book about it, only work if you have the kind of infrastructure, the kind of public services that can deliver it. And the same with things like universal healthcare and social care and these sorts of things that upon which our economies actually rely. And I think we're beginning to discover just how much we rely on them and what a folly it is to cut them or to underfund them in the name of reducing public debt. The primary responsibility of any government, and that including its central bank, is to its people, is the prosperity of its people. And what we have done by fetishizing debt and deficits over the last 10 years has been to make an awful lot of people poorer. In my view, that is a massive failure. Fiscal policy is extremely powerful. We know that historically, and there have been some awful examples of it going horribly wrong. That doesn't mean that fiscal policy should do nothing, but it has led us to seriously cut or to tie down or restrict what we allow governments to do. Governments are restricted by law from, for example, in some countries, running much of a fiscal deficit. They may have debt breaks that prevent them from running deficits at all. They may have caps on public debt, and these have nothing to do with the needs of the economy or of their people, and everything to do with a fear that the spending and the debt will get out of control and become unaffordable, and the whole thing will go horribly wrong. And as I said, there have been examples of that in history, and we should not be blind to that risk. And that brings me to the role of central banks. Part of the fear of powerful fiscal policy, and the reason why we restrict it, is there are limits to what central banks can do. Within a band, a central bank can control the yields on its government's sovereign debt. It can supply its sovereign with money, as Geoff has suggested. It can do all of that, but there are multiple equilibria here. We know from literature from the 1980s that at one end of the spectrum, a central bank can finance an out-of-control spending program to the extent that inflation runs away with itself and becomes unstoppable. And I think we've also seen the limits now on the downside, that a government that is hell-bent on austerity cannot be rescued by its central bank. The central bank can keep on doing QE, buying up all its debt, giving it signals to spend, but if the government doesn't take any notice, what we end up with is an economic slump, which the central bank can do absolutely nothing to fix. And that is, I think, the fear that I see now, the concern that I have. We're at a very dangerous point now. In 2010, we made a disastrous turn to austerity, and I don't just mean in the United Kingdom. It was a global turn to the austerity. I think the one major economy that didn't do it was China, and actually the world owes a huge debt to China for maintaining fiscal stimulus when everybody else was stopping it. Germany in particular benefited hugely from the Chinese fiscal stimulus, and in my view that was a lot of the reason why the Eurozone actually managed to avoid a 1930s depression. A part that is from Greece. Everybody else was busy saying, oh no, we've got to get our debts and deficits under control, and cutting government spending. And the spending cuts very often were targeted at the people who were least able to bear it. They were not targeted at the top end. They were targeted at the poor. They were targeted at the vulnerable. We underfunded social care. Well, we barely funded it at all. We underfunded our health services. We cut unemployment benefits. We cut in-work benefits, and so on and so forth. All of it to get debt under control. And in some cases, while simultaneously handing out money to people, to better off people. It seems to me that if we make that mistake again, if we do the same thing again this time, we're going to be in an even worse mess. So it is important that we learn, first of all, that fiscal policy is primary. It's very powerful. It's what we need to do, and that governments have a responsibility to ensure the prosperity of their people. And secondly, that we must not make the mistake again of expecting central banks to do all the heavy lifting. There are things central banks still could do that they're not doing, but really the buck stops with the fiscal authorities, and that's where we should be looking now. Do we have Martin?
I am back. I'm so sorry. I must have been something on my end. So I understand that you've been able to go ahead without me and even take care of your own timing, which is just wonderful. I'm sorry, Francis. I missed most of your presentation, but I know that it will have been good because I follow your work. Otherwise, I will simply hand it over to Joe for the last presentation and try to get back into the swing of things after your 10 minutes. Joe, go ahead.
Thank you very much. I'm going to make three provocative comments and try and defend them in the short time I have, which is going to inevitably mean I'm going to be a little bit light on detail, and I might be a little bit skimpy on some of the finer points. And then I'm going to try and make a conclusion briefly at the end. And my conclusion will be very similar to the conclusion that Francis just laid out. So my first proposition is that, this is number one, economic systems are path dependent, meaning that the current situation in the economic system, current policy, current business investment, current employment, current technology, and so on, have persistent effects. So if we look forward 10 years into the future, what's happening now will fundamentally affect where our economy is in the future. Now, that might seem absolutely obvious and straightforward to somebody who is not an economist or a macroeconomist, and I'll try and tell you why I'm saying something so completely obvious. But first, let me give you an example to try and make this a bit clearer. There's an alternative imaginary universe, what an economist would call a counterfactual, in which we didn't have austerity from 2010 to 2020, and we go into the new decade, starting 2020 to 2030, with a global pandemic without having had that decade of austerity beforehand. And I would argue that if you then fast forward another 10 years to 2030, you're going to get a very different outcome to that decade, starting with the pandemic, if you didn't have the decade before of austerity. And again, I hope that might seem like a reasonable thing to say. The reason I raise it is that economists in their modeling, and I think actually mistakenly, I've often taken it from their modeling to think about the real world, tend to assume that there's some sort of externally imposed path that we're on, something like this. And all the economy does is kind of get knocked off track and then get pushed back onto track again. And the job of the central bank is just to sort of nudge economies that are knocked off track, whether they're going a bit too growing a bit too fast or growing a bit too slow, back onto their to their fate, their externally imposed fate. And in certain types of models, mathematical models, you kind of need that assumption because otherwise things mathematically fall to pieces. But I think it's been a real mistake, and it has it's underpinned the idea, as Francis said, of central banks as the key stabilizing policy tool. Is this idea of a sort of externally imposed fate for economies, what economists call a long-term equilibrium or a steady state growth path or something. Not all economists. The great Polish economist Michał Kalecki a long time ago said that the long run is simply the sequence of short runs. And I think that's absolutely right. And I think that one of the things we're learning at the moment is that view is probably correct. That's number one. Proposition two is that there is no such thing as a natural level or rate for many key macroeconomic indicators. There is no such thing as a natural rate of unemployment. Crucially, there is no such thing as a natural rate of interest. Now, this might sound very technical, but I'm going to also try in my 1 minute that I've got for this point to explain why I'm saying this. Economists are very wedded to the idea of a natural rate of interest. And what that means is that there's some number out there, some magic number. And if we can find out what that number is and make that number the rate of interest that people in the economy experience. So lenders pay that rate of interest, borrowers, wrong way around, borrowers pay that rate of interest, lenders receive that rate of interest. If we can somehow get that number out there into the economic system, and that's the central bank's job, is to do that, then everything else automatically comes into alignment. Unemployment, inflation, growth, somehow this one single number brings everything kind of into focus and into alignment. And I think that's fundamentally incorrect. I mean, some economists have argued that there simply isn't a single natural rate of interest. And it's connected to my first point about path dependence. And the reason this matters is that if you believe there is a natural rate of interest that you can't do anything about, then all the central bank can do is try and get the market rate of interest towards that kind of externally imposed number. Once you reject that, in my view, false belief about a so-called natural rate, then you can use interest rates as a policy tool to try and further the government's wider aims, such as reducing poverty, generating growth, a green transition, etc. It also means if we reject this view, for example, that the bond vigilantes in 2010, the people who said, well, we have to have austerity because otherwise interest rates will go up. I mean, they were just wrong, and they need to be called out on this. People still sort of say you need to be careful about the deficit and the debt because interest rates react to government deficits. And I think one lesson we've learned is that is a very hard claim to defend. Incidentally, before I move on to claim number 3, I think the fundamental difference between MMT, modern monetary theory, many of you will have heard talk last night, and more conventional economic analysis is actually this rejection of the idea of interest rates as the thing which bring the whole system into some kind of automatic equilibrium, is the technical term. And it's not often sort of written on the outside of the tin, it's buried in the small print. But I think really that's the important difference between MMT and other economic ideas. And once you reject this idea of a natural rate of interest, your hands are much less tied in terms of policy intervention. Okay, point 3, and then I'm going to try and conclude. I think I've got about 4 minutes left, but I'm sure Martin's going to tell me if I'm overrunning. Point 3 is that many of the trends we've seen since around the 1980s shouldn't be seen as separate from the macroeconomic trends. And I'm going to give one example. The trend of rising income and wealth inequality and wealth concentration within rich nations since the 1980s should not be seen as separate from the stagnation story, for a simple reason that the rich and the wealthy tend to spend a lower proportion of their income than the poor. So if you have a redistribution from the poor to the rich, the overall effect is to reduce total spending as a share of available spending, and therefore to introduce stagnationary tendencies, to introduce weak growth, potentially weak investment, weak productivity growth. I don't think this is the only reason at all, but I give one possible example. So treating inequality as a kind of moral issue, a micro issue, and macro as something to do with central banks and interest rates, in my view, is fundamentally wrong. We need to connect these different big picture macro trends and see them as all part of the same problem. And this stagnationary tendency coming from income inequality, as well as other things, weak business investment and various other factors, I think was countered by a number of sort of countervailing tendencies or forces, one of which was rising household debt, often mediated through real estate bubbles, rising house prices, capital gains. That came spectacularly to an end in 2008, as we all know. And again, the case was made by people from the 90s through the 2000s that inequality, global imbalances, real estate booms, financial activity were connected and were macro stories. And those people were largely ignored, sidelined, but I think they've largely been proved right. So those are my 3 controversial propositions. I'm now going to very briefly try and come to a conclusion in about 1 minute and 30 seconds, because I can see Martin's going to tell me to be quiet.
You've got 2 minutes.
Oh, wonderful. Thank you. So what this means is that asking the question about how should we react to an era of falling interest rates, moving towards negative interest rates, QE, stagnation, is in a way a wrong way to frame it, because these are not externally self-imposed things which have just sort of come out of the ether. These are, to an extent, the result of misguided policies, the result of the breakdown of the post-war consensus between labor and capital in the favor of capital, the belief that central banks alone could do all the heavy lifting of keeping an economy on track, and the move away from fiscal policy. Treating the deficit as a symptom is wrong. You shouldn't try and treat the deficit. The deficit is a reflection of underlying and deeper imbalances in the economic system. And in my last 30 seconds, what I would say is that I think inevitably government activism and size are going to be a feature of the next decade. I agree very much with what Gavin Kelly said in his introduction. Should UBI be part of that? I'm absolutely convinced that the social safety net has to be strengthened significantly. Whether UBI is the right delivery mechanism, I'm not yet 100% convinced, but I think it's a really good conversation to have. Is sovereign money the way to get us there? This one I actually think is a bit of a red herring. I'm not convinced that sovereign money is a hugely useful way to think about this, but I have run out of time, so I'm not going to have time to explain exactly why that's my view. So I conclude there.
Thank you so much, and we will certainly pick up on that question because it's a great point for taking it forward. I mean, just to draw out some common themes here, I think there are at least kind of two axes of thinking about the big issue here. One is, as Joe just raised, is the problem here that macroeconomics is facing new challenges from the outside, as it were. The economy has changed. There are new things that the old macro cannot deal with. Is it sort of exogenous in the jargon, or is it endogenous? Is it due to bad macroeconomic policy itself that we have the problems we have? That's one kind of axis. And the other is, whatever the answer to the first question is, do we really need to go to completely non-standard tools, such as using sovereign money actively for a UBI or something else? Or are there ways of using what at least has become standard, for example, QE, even lower interest rates and so on, but something that's recognizably within the way macroeconomic policy has been done by people in power to solve that? So I think those are kind of two axes. And you could get to a UBI, sovereign money finance UBI answer on both of them. You could say, well, it's because we've treated macroeconomic policy without thinking about these more radical things that we are in the problems we are. Or you could say, well, it is exogenous, an exogenous shock, but that's why we need to move beyond how macro has been done. Now, I think one way to maybe pick up on this, I'd like to go back to James, who I think, at least compared to the rest of the panel, operates most within what, in HMT, at the Treasury, among sort of established policymakers would be accepted as acceptable. Because there are some questions that have come up. One question that has an extra vote is, can James say more about why the Bank of England cannot use more QE this time? I'd like to broaden this out. Why did you say that the central banks, that the monetary policy side cannot do very much more? And I will ask the others also to weigh in on that question. What really is the limit to using the sort of tools we already have established? Why is it really, if that's what you think, important to go beyond? And we'll return to Joe with that too, where he can explain why he doesn't think we need to go as radical as sovereign money. But James, can we start with you? Maybe if I mischaracterize you, please tell me. But it does sound like there's a bit more of defense of convention relative to the other panelists.
Just on monetary policy, I think it's really, really simple. So the Bank of England can cut rates lower, can cut rates negative, but there's a diminishing return to cutting rates. And I think there's a lot of fixation on negative rates. I think it might help a bit, but it's not going to provide you large-scale stimulus. And therefore, it's to use the phrase earlier, it's definitely a red herring in terms of macro policy terms. It's not something we can rely on to generate a rapid recovery. And then when it comes to QE, the bank can do more QE at the margin. It might be helpful, but when the whole term structure of interest rates is below the lower bound for interest rates already, there's not that much the bank can do to lower longer term interest rates, and therefore they're not getting much bang for their buck at that point either. So I think a big problem here and is that there's a bit of ambiguity about the extent to which central banks can deliver a rapid recovery, can support the economy. So you've got central bankers all over the world, the Fed, the ECB, and even some members of the Monetary Policy Committee in the UK, saying that we need more fiscal policy. And that is code for we are out of ammo, we have done all we can, we cannot do more to support the economy. And this is really stark in the US, where the Fed have basically said that they want to overshoot their inflation target, have even higher inflation, yet when you look at the forecast for all the FOMC members, the people who set the interest rates, they're still barely getting above 2%. So there are definite limits, and there has to be a real conversation about how we address those limits and how we change how we do macro policy.
Just to follow up, does that mean there's an alignment here between you and Joe in that lowering interest rates in the wider economy isn't really the tool it used to be? Is that a fair description of what both you and Joe are saying?
Actually, we definitely need to confront that issue.
I think I would go further and say it was never the right tool, or at least in isolation, it wasn't the right tool. Right, so it's not that it's become the wrong tool; it never really was the right tool.
Joe, since you now have the floor, why don't you explain why that doesn't mean that we need to use sovereign money as the tool? Which I understand that using the central bank's capacity to issue money more directly.
Yes, so maybe while I have made three propositions which would make a well-behaved macroeconomist blanch a bit, in terms of the policy conclusions, I think I'm very close to what's just been said. We haven't been using fiscal policy for the last, I think, more than 10 years. I mean, actively, fiscal policy has been aimed at reducing the scope and capacity of the state for the last 10 years and actively reducing aggregate demand. And I think that's a fundamental mistake. And what you see in terms of interest rates is a reaction to that. And the central bank trying to counteract with one hand what's being pulled on the other hand. And one is stronger than the other. So you end up at zero and QE and all this stuff. Why do I think we don't need sovereign money? This is a little bit technical, but I'll try and do it as quickly as I can. When the government doesn't tax, it has two options. It can issue bonds, or it can issue another type of instrument, which I'm going to call cash, which is a little bit not quite right, but it'll work for now. And they have different rates of interest. And really, all you're doing when you're choosing between those two instruments, bonds or cash, is deciding which rate of interest you want to pay. So to me, that choice of financing instrument, bonds or money, is really just about setting a rate of interest. And at the moment, the rate of interest on both of them is so close that it makes almost no odds. So I don't see the justification. Why don't we just issue more bonds? And they're actually on negative real rates. What's the argument against normal fiscal policy and bond issuance?
Francis, I'd like you to come in, and I don't want to ask a question because I'm worried that I asked something you already answered in introductory remarks. Can you just pick up on what's just been said and tell us what you think?
I'm inclined to agree with Joe, actually, because I think the collapse of the term structure of interest rates, I think, is so fundamental that the distinction between money in the present and money in the future is extremely narrow. We can regard bonds as kind of future money, and money, cash, for want of a better word, as money in the present. And what QE does, in effect, is convert money in the future into money in the present. And that applies to any form of QE, whether you're calling it QE for buying bonds and so forth, or handing out money. Either way, you're creating more money in the present. When your term structure of interest rates is completely on the floor, whether you finance your government spending by creating money or by issuing bonds is neither here nor there. So, broadly, I'm inclined to agree with Joe that I think the fundamental thing here is the collapse of the term structure of interest rates, really. And that moves us towards really what the role of central banks is, which I think is undergoing this sea change that we're perhaps not aware of, which is that they're moving away from direct control of the macro economy towards backing up the sovereign, really, towards holding the sovereigns back while the sovereign gets on with supporting the economy, providing money, putting money into the economy. And then that raises questions about where that spending is directed and how it has the greatest effect and how it brings about the greatest effect of prosperity for the greatest number of people, which is actually the role of the macroeconomic actors as a group, the central bank and the fiscal authority together. It's the job of government.
Just to be concrete there, Francis, what you mean is holding the sovereign funding interest rate, the cost of the government to issue bonds, down.
Yeah.
So I hear, and I want to move to you now, Geoff, because I hear the other three panelists basically saying you can get what you need as long as you do enough fiscal bond financed government spending. And then maybe there's some disagreement about whether that counts as a central bank targeting interest rates or not. That's maybe a bit technical, but at least there seems to be a sense that you don't need to go as far as sovereign money. Geoff, what's your response?
Well, first of all, I'm in support of fiscal policy. I mean, UBI, in my view, is a fiscal policy. Cancelling austerity is a fiscal policy. Where I'd be more radical than James and Joe about the monetary side of that policy is that, in my view, the definition of government bonds as debt just becomes a nonsense. So, we've currently got an economy where the debt is equal to the GDP. And in Japan, they've got an economy where the debt is equal to 2.5 times the GDP. Now, everybody knows that debt is never going to be repaid. No economy can repay 234% of its GDP. What it does impose is a significant interest cost, which is currently 39 billion a year in the UK, where the taxpayer is funding the financial sector. And the problem I'd have with what Joe said is that although, and as Martin Bull said actually, although interest rates are currently very low, we've got no guarantee that they're not going to rise in future. So I wouldn't want to take a present day low interest scenario to justify a policy which is accepting debt into the economy. So I think that there would be, my challenge is, what would happen if the 2 trillion of debt in the UK were currently defined not as being debt, but just as money issued into the economy? And the same with household debt. We can't allow low-income households to have to supplement their income with further debt, and they need an income source.
Sorry, I'm trying to unmute myself here. And can you just, again, you covered this a bit in the presentation, but can you again just say in very plain terms, what does it look like in practice to define these debts instead as sovereign money? It means just giving people accounts and putting central bank money into them.
Yeah.
Just give us the institutional setup and what does it look like? What does it feel like to an ordinary citizen?
At its simplest, yes, you just have everybody's bank account and you just put sovereign money into it. And I argue in the slide that the 745 billion of government debt currently held by the Bank of England is as quasi-sovereign money as you can get. Here's the state via its Treasury and its Bank of England only owing itself. So there isn't actually a debt. I claim that that's an empirical evidence of the inevitability of sovereign money in a high-tech economy.
There is another question that follows on nicely from this, also in the interest of keeping things concrete. Stephen asks, what would be the impact of introducing UBI in the UK this quarter? So I'd like you all to have a quick stab at that. Suppose we got it now, and if you want, you can distinguish between whether it will be sovereign money financed or bond financed. But suppose we just did it. We flicked the switch. We introduced a meaningfully sized UBI now. Geoff, do you want to start?
Yeah, well, in my view, that is actually what's happening. I mean, the furlough scheme, it's only a quasi version of UBI, but it's approaching the idea of a UBI. The government is just putting money into people's pockets and without them working. And automation in the economy is going to lead to that increasingly needing to be the case. So the great review will be that aggregate demand will be held up and households won't have to incur debt in the way that they've had to so far.
Francis?
Okay, my view is slightly different because I've been looking at the saving ratio. And the saving ratio right now is heading for the skies, which is indicating that British households are actually saving like mad. There are lots of reasons for this. One is that people who are on high-ish incomes and are able to work from home actually haven't needed a furlough scheme. They've carried on earning, but they have been seriously deprived of anything to spend their money on. So they're saving like mad, kind of de facto, because they have no choice. We also have an increasing precautionary saving by people who fear that their jobs and incomes are going to vanish overnight, which is distinctly possible. And we also have people who are simply uneasy about going out and doing things which involve spending money because they're afraid of catching the virus. So there's a number of reasons why UBI right now across the board, remember the emphasis here on universal, actually I think might not prop up demand in the way that Geoff thinks. That's not necessarily a reason not to do it, but we should be aware that it's, it would potentially help people towards the bottom end of the income spectrum, particularly those who are losing their jobs, losing their benefit, losing their employment, and self-employed people, the people who are dropping down the cracks and not covered by the other schemes. It would help them. But right now, I'm not convinced that it's necessary as a demand stimulus. And I say that as somebody who is, on balance, a long-term supporter of UBI. I wouldn't like to see it as a panacea right now. I think it would simply raise the saving ratio even more.
I think this highlights how UBI is a policy that has many friends, but often for different motives. For some, it's a way to stabilize or solidify demand. For others, it's basically a social policy to combat inequality and so on. Joe, what do you think would happen if we flick the switch and introduce UBI now?
Putting aside the problems with the computer systems and how you would actually implement it, I think you would want to do it alongside a plan for how to claw a lot of it back from people like me, who, as Francis said, I've been spending less because the things I usually spend on are not available for various reasons to do with the pandemic. So I do think that we need an immediate safety net for those at the bottom who are facing serious cash flow issues through no fault of their own because of sectors shut down and so on, and government support being wound back. Early in the pandemic, I actually, with the autonomy think tank, made a proposal for flicking the switch on universal credit and making it a kind of basic income in the short run, while a plan was formed on how to actually get cash to those who really need it. But that would be the same kind of argument I would make now. Is it could work to kind of hold the dam until we can come up with something more sensible and targeted. And I don't think we do want demand stimulus right now because we're so unsure about the pandemic situation. I think we want life support. We want to stop people being turfed out of their houses and so on, just because cash flow can't cover rental income, rental payments and things like that.
James.
Yeah, I found it tough to talk about UBI in general terms because how you design it matters a lot. But let's say you put money in the hands of people on lower incomes. Now, in the US, that has been the policy. And, having tried to design support schemes for in a similar sort of way, it sounds like what Joe's been doing for the UK. Seeing what happened in the US made me feel like I just lack some imagination because, they've given $600 every week as part of their unemployment benefits. And, some of these people are on a fraction of that. So they've just got an incredible amount of money into the hands of the people who are going to spend it very quickly. And, work from Raj Chetty and others shows that's been incredibly powerful in terms of, continuing economic activity. And it's tough thinking about stimulus in this crisis because there's very clearly limits to, how much economic activity there can be in order for that to be consistent with virus not spreading in an absolutely rampant way. So, but I think the thing to think about here is there are some people who are having full savings, living their lives, their balance sheets are improving. Those are people on higher incomes who haven't lost their jobs. And there are people on lower incomes who are much more likely to have lost their jobs and taken a big income hit. And if you just allow that income hit to persist, so if people fall onto universal credit, then it's going to push us into an absolutely massive recession because it's a big hit to the incomes of people who would spend the most money to begin with. So we need to think about stimulus. We need to think about it differently. So you need to think about, particularly in the suppression part of the virus phase, thinking about boosting income, preserving incomes, and reducing those income shocks. At the moment, my concern would be that we're not doing enough of that, and therefore we're going to be in a deeper economic hole because of it.
So much. We could go on forever, but we are pretty much out of time. I wanted to raise one thought, which is on Joe's point: how do you get the money to people? That's been something a lot of countries have realized is actually quite hard in this crisis. And I just wanted to highlight how a lot of central banks have got very interested in digital currencies recently, with an ECB report out last week, a Bank of International Settlements report out last week. This seems to be coming and could affect this whole discussion significantly. I want to read out two comments just to illustrate how great an audience we have, an audience interaction we have. Dave says a UBI would be a great way for Generation Rent to be able to save for a deposit for a mortgage. And Anne responding, UBI for people in rent arrears, many, would currently just go to pockets of landlords, which would reduce private debt of tenants, but not increase spending by landlords. And then the conversation has gone on about how you would need a rent cap with a UBI. Just an illustration of the sort of discussion that's spurred from the panel in the wider audience. We need to end. I'm very sorry to say. I apologize again for losing connection halfway through, but I'm glad you soldiered on without me. Thank you so much to all the panelists. Thank you very much to the audience and, of course, to the festival organizers. I understand that everyone should just kind of stay on and you'll be digitally ushered into the next session, so do that. But from us, give a virtual applause to the panelists, and thank you everyone very, very much. I think somebody will now push a button, but we will just sit here and stare until then.
Great. Okay. I hope you can hear me. Thanks very much indeed for that fantastic session. Thank you, Martin, for chairing that so brilliantly in the teeth of some technical challenges. Excellent chairing and brilliant contributions from James, Francis, Geoff and Joe. Historically informed, theoretically rich and radical, and addressed to some real world issues and problems, very, very pressing ones. So thank you very much indeed for a really excellent discussion. And I think where the panel got to with the sort of consensus, if you like, on the importance of fiscal policy, but then how you think about distributional questions, particularly for income transfers, how they relate to problems of demand and saving in the economy currently, but also to who money gets to and how, is going to be a big focus of our next discussion in the panel after lunch, where we've got some brilliant political economists and think tankers and others coming to talk about this relationship between fiscal policy and the welfare state, whether we should continue to strengthen and reform existing welfare states or try to move to something like a basic income. So that'd be a big part of our discussion this afternoon. So we come back just before 1 o'clock, about 10 to 1, and then at 1 o'clock we'll go into our second panel. So thanks ever so much for, well, nearly 500 of you who've been with us this morning. Please do come back after lunch, as many of you as possible, because we've got great sessions coming up. Keep asking your questions, and I'll do my best in the sessions I'm chairing to make sure that we answer those too. So thanks very much indeed, and see you all at about 10 to 1. Thanks very much.